China's economy just posted a 5.4% growth rate for the first quarter of 2025. And on paper, that sounds like good news. In fact, it beat analyst expectations. But here's the twist. Behind that headline number is a story of deep structural trouble and a growing fear that the world's second largest economy may already be past its prime. This video unpacks what economists really mean when they say China is peaking. It's not about a single bad year. It's about a long-term turning point. We'll look at what's driving this shift, what it means for China, and, more importantly, why it could rattle the entire global economy. Whether you're in Chicago or Cairo, China's economic health matters. It drives global trade, moves commodity prices, and shapes political decisions. If China slows down for good, the ripple effects could reach everywhere from your local job market to international peace. Let's start with the surface-level stats. China's Q1 2025 GDP rose by 5.4%, driven by a rebound in factory output and a surprising jump in retail sales. That sounds strong, but zoom in and the cracks start to appear. For one, the country is still technically in deflation. Prices aren't rising, they're falling, a sign that consumer demand remains shaky despite government efforts to boost spending. And while home prices stopped falling as fast as before, the housing sector is still deeply wounded. New construction is down and investment hasn't bounced back. What's more, the upbeat GDP number may be misleading policymakers into thinking they don't need to act, when in fact, the economy is walking a tightrope. Economists at Bloomberg and the IMF warn that without real structural reform, this recovery could be short-lived. So if China's not crashing but not growing like it used to, what exactly is going on? In the next section, we'll dig into the 5 forces dragging China toward a long, slow peak and why some of them might be impossible to reverse. If China's economy is still growing, just more slowly, why are economists so anxious? The answer isn't just in the numbers, it's in the structural gears of the economy, the kind that don't get fixed with quick stimulus checks or interest rate tweaks. Let's walk through the 5 big forces that suggest China may be settling into a permanent slowdown. Number 1, demographic decline. China's population is shrinking. In 2023, it officially declined for the first time in 6 decades. The country now has fewer young workers and more elderly dependents than ever before. It's like trying to run a relay race with fewer runners and more people riding on their backs. This isn't just about aging. It's about shrinking labor supply, weakening consumer demand, and soaring pension costs. Economists have a name for this: demographic drag, and it's very hard to reverse. Number 2, a property sector on life support. Real estate once made up nearly 30% of China's GDP, but now it's a drag. Developers like Evergrande and Country Garden are symbols of a bursting bubble. The government tried to prop things up, and yes, in early 2025, the free fall slowed, but that's not the same as recovery. Cement output in March 2025 fell by a record 22%. That's not a sign of a housing rebound. It's a signal that construction has ground to a halt. Number 3, debt, and more debt. To keep the economy humming, China has leaned heavily on debt, from households to corporations to local governments. And now, those bills are piling up. Local governments in particular are struggling. Many borrowed aggressively during the boom years to build infrastructure. Now those projects don't generate enough returns to pay the loans back. This isn't just a finance problem, it limits China's ability to stimulate the economy, because every new loan adds more strain to an already creaking system. Number 4, tech tensions and supply chain strains. China has ambitions to lead in AI, chips, and advanced manufacturing, but the US and its allies have drawn a digital red line. Export controls on semiconductors and chip-making tools are biting. Beijing is pushing for self-reliance, but replacing global tech inputs takes years, not months. Meanwhile, foreign firms are rethinking their presence. Apple, for example, is shifting more production to India and Vietnam. De-risking is the new buzzword in boardrooms worldwide. Number 5. Trade wars and global pushback. In April 2025, the US slapped new tariffs on Chinese ships and tech exports. China retaliated by halting LNG purchases from the US. This isn't just a squabble. It's part of a broader shift where countries are no longer comfortable depending on China's factories, ports, or influence. Add it all up, and you get a very different picture of the Chinese economy. One that may no longer be climbing, but quietly plateauing. This is what economists mean by China's peak. Not a crash, not a crisis, but a slow-motion stall. One that's incredibly difficult to restart. So, why does this matter to the rest of the world? What happens when a giant stops growing? In the next section, we'll explore the ripple effects of China's peak and how they could jolt global economies from Berlin to Buenos Aires. If China's growth stalls, it doesn't just affect Beijing, it sends shockwaves across the globe. But what exactly happens when the world's second-largest economy starts moving in slow motion? For 2 decades, China acted like an economic engine for the world. It bought raw materials from Latin America, oil from the Middle East, machinery from Europe, and chips from the US. If that demand starts shrinking, global supply chains could seize up or shrink in tandem. Take Germany, for example. As China's biggest European trading partner, German auto and machinery exports are directly tied to Chinese consumption, and right now that demand is wobbling. Even Chancellor Olaf Scholz's visit to Beijing in April 2025 focused on overcapacity concerns and warnings to treat foreign firms better. China consumes more than half the world's metals: steel, aluminum, copper. It's also a top buyer of oil, soybeans, and lithium. A slowing China means falling demand. That's bad news for resource-rich countries like Brazil, Australia, and Nigeria. Fewer Chinese construction projects mean fewer bulk carriers, less iron ore, and more unemployed miners. Already, oil prices have slipped as Chinese industrial output flattens. And while OPEC Plus watches demand anxiously, there's no clear sign of a rebound. Financial markets are also reacting. The CSI 300, a major Chinese stock index, dropped after the Q1 GDP report, even though the numbers beat expectations. Why? Because investors fear that policymakers will see the good news as a reason to hold back on stimulus. Meanwhile, concerns about rising tariffs and the yuan's weakness keep rattling investor confidence. In Asia, emerging markets that once boomed on China's coattails are now exposed. Vietnam, Thailand, and Malaysia, for instance, are navigating a tricky pivot, trying to keep Chinese capital flowing in while also diversifying toward US and Indian markets. With China's growth slowing and tensions rising, friendshoring has become more than a buzzword. Companies are pulling supply chains out of China, not just for political reasons, but because they fear instability, both economic and geopolitical. Apple's move toward India, Tesla's interest in Mexico, and even Walmart's shift toward Vietnam are part of a broader pattern. The result? A more fragmented, less efficient global trade system with higher costs for consumers everywhere. In short, China's peak isn't just a Chinese story. It's a global one. From stock markets to shipping lanes, steel mills to supermarkets, the aftershocks are already being felt. But here's the wild card. What happens when a peaking power feels boxed in, economically, diplomatically, even militarily? In the next section, we'll explore why some historians and economists fear this moment the most, and what it could mean for peace and power in the 21st century. History doesn't repeat itself, but it often rhymes. And when economists look at China today, some of them hear an unsettling echo from the past. What happens when a rising power stops rising? There's a theory in international relations known as the Thucydides trap. It's the idea that when a rising power threatens to displace an existing one, conflict becomes likely. But there's a lesser-known cousin to this idea, just as dangerous, called the peaking power problem. Here's the basic logic. When an ambitious nation realizes its economic momentum is running out, it may act more aggressively to protect or expand its influence while it still can. Think of Imperial Japan in the 1930s, or even Germany before World War I. Both were industrializing powers that sense their windows closing. That urgency often leads to bold, risky moves, sometimes military, sometimes geopolitical. Right now, China's leadership is juggling multiple pressures. Slowing growth at home, a fractured relationship with the US, trade barriers tightening, tech restrictions mounting. So where can Beijing turn? One path is nationalism. In times of economic stress, governments often pivot toward patriotism to unify public sentiment. That could mean firmer rhetoric on Taiwan, more naval activity in the South China Sea, or tighter control over Hong Kong and foreign companies operating in China. Another path is acceleration. Instead of pulling back, China might double down on industrial policy, foreign investment, or regional dominance before its economic clout fades too far. What makes this scenario risky isn't that China wants conflict, it's that pressure may distort its risk calculations. Economists call this the window of opportunity effect. When a country fears its future power is slipping, it's more likely to take chances it wouldn't normally consider. And if rivals misread those moves as aggression rather than desperation, tensions can spiral. Already, the rhetoric is heating up. The US is tightening the screws with tariffs and tech bans. China is responding with trade cutoffs and warnings to allies not to follow Washington's lead. This isn't just an economic story anymore. It's about strategy, psychology, and power. A peaking China may be less stable, not more. And that's what worries economists, generals, and diplomats alike. So, is China truly peaking? And if so, what does that mean for the rest of us, today, tomorrow, and in 10 years from now? In the final stretch, we'll pull the threads together and answer the big question, what should the world expect next? After all the data, trends, and warnings, let's return to the core question. Has China really peaked? Or is this just a rough patch in a long climb? Here's what most economists agree on. China isn't collapsing. It's evolving. The days of 8 to 10% annual growth are over, and probably for good. But a long plateau around 4 to 5%? That's realistic. And for a $19 trillion economy, that still adds a lot to global GDP each year. What's different now is the tone. Even with strong quarterly numbers in early 2025, the underlying sentiment, both inside and outside China, is cautious, not confident. Why? Because the levers that worked before, cheap labor, property booms, state-driven investment, no longer deliver the same returns. The future will require tougher reforms. Pensions, innovation, market openness, all politically sensitive, all hard to execute. A peaking China doesn't mean a powerless China. It means a different China, one that's less focused on breakneck growth and more concerned with stability, security, and global leverage. Expect China to keep asserting itself regionally, from Southeast Asia to Africa. Expect more economic nationalism at home. And expect the rest of the world to keep recalibrating, diversifying supply chains, building new trade alliances, and preparing for a more multipolar economic map. For ordinary people, the effects will be indirect but real. Prices of goods may fluctuate as supply chains adjust. Energy and commodity markets will remain volatile. Global interest rates, inflation, and job markets could all react to shifts in China's trajectory. More than anything, expect uncertainty. Because when a giant like China changes course, the whole world has to shift its balance. So yes, it looks like China has hit its economic peak. Not with a crash, but with a slow, powerful pivot. The kind of change that reshapes not just trade routes or GDP charts, but global power itself. And when giants pivot, the ground shakes, not just in Beijing, but everywhere.